had an experience this year that I want to share with you guys. I lost $700 on a very simple IBIT trade, and I learned some lessons. I've been trading options for 17 years. I've been founder and a president of CFU, Cashflow University, for 3 years. Even I still make mistakes, and I want to share with you the mistake I made and how you can learn from it as well. So this was on the IBIT ETF. IBIT is the Bitcoin spot ETF by BlackRock. It is one of the best ones. It's the most liquid. It has a bid and ask spread, and it's just a fantastic ETF to trade if you are interested in trading Bitcoin as an ETF and not as cold stories. It's very easy to sell covered calls on. So this scenario that I'm about to share with you today started in November 2025 and it ended in November 2025. That's how quickly this trade went against me. And I fixed this going forward with 3 simple rules that I'll share with you today. Covered calls are always seen as the low risk, easy way to generate some income. And I know on social media, it's often touted as, hey, I just went in and I raised $2,000 or $3,000 off of my stock and it's my money. It is your money. You do get to keep it. And you'll see in my scenario here, I got to keep the $250 that I got when I sold my covered call, but it isn't really that easy. What I owned 100 shares of IBIT. I bought that at $60.19. I sold the 66 call for $2.50 premium because I have 100 shares on the one contract that works out to $250 cash. Lands in my brokerage account immediately. My net cost basis on the position was then $57.69. Okay, so my outlook on the trade, I very much believe in Bitcoin and the Bitcoin thesis. I've read the Bitcoin standard. I have read the white paper for Bitcoin. I have mined crypto in the past. For a very long time, I was an Ethereum miner. And even when it went to proof of stake, I hosted my own node. I had over 32 ETH and I staked. I put that in the past tense because I, for a long time, got out of crypto and I focused on building CFU. But still inside me, I still believe that crypto has a bright future. I still believe in Bitcoin. I still believe in Ethereum and to a lesser degree, Solana. But Bitcoin is great. Sure money, cold money cannot be diluted. And it's an asset that has a fantastic future ahead of it. I want to be a part of that. I want to own Bitcoin. So trading a covered call on Bitcoin to me makes sense. I love it. I'm going to do it. My outlook was neutral to mildly bullish. I expected that $250 income to stay with me, and then I would continue to sell additional covered calls. What could go wrong? An absolute worst thing could have happened, did happen. Let's unravel it even more. Okay, so let's just start with the chart. This is what I was looking at when I sold the covered call. Now, in fairness for this chart, it is in past tense. So we are looking back at the chart. As you can see up at the top right-hand corner there, it's 54.24. And so this is hindsight. But when I was looking at the chart, this is where it was. Bitcoin is trading around $60. It had just come off of the high. You can see the high in here, right around here. I'll just show you that with my mouse. So this is the chart that I was looking at when I started my Bitcoin position and when I was going to sell the covered call. I know it says 54.24 on the top hand corner. That's because the chart is looking backwards. I just took that snapshot from today. But looking back, Bitcoin was trading at $60. It had already come off of the high of 69 around there, and it was pulling back already. It had already found that basis at the bottom. It had already formed that basis off the bottom here. It had already legged up twice. So I was thinking this is a great time to sell a covered call and to enter into the position. It was showing some strength. And because I love Bitcoin so much, I was like, yes, this has legs to go up. So right here at this point, this is where I sold my covered call. And not only was I able to, this is trading at $60, I was able to sell the 66 call on this. That was a fantastic sale. And I was able to get $2.50 in premium for selling it just under 1 month out. It made all the world in a lot of sense to me. Bitcoin does what Bitcoin does. Reality hit hard. Almost immediately after I sold the covered call, The precise thing I do not want to have happen. Bitcoin sold off very quickly. There was regulatory news, there was volatility coming in, and ETF outflows. Plus, Michael Saylor was still doing his ATM equity sales on MicroStrategy and buying up Bitcoin, but it wasn't enough. It corrected to the downside, 15.7% cut off in 7 days. It went from $60.19 down to $50.73. I can show you the chart in a second here. My net loss on this position was $696, $700. Like round it up, give me $4 extra on this. I lost $700. My premium only cushioned $250 of that. So having a covered call is not like wearing a bulletproof jacket. Having a covered call is like you have a cushion. You've got like a little bit of extra, like you stuffed your pillow under your jacket. Somebody took a shot. Yeah, it slowed the bullet down before it hit you, but the bullet still hit you. This is the end chart. I'll zoom in again. This is where I entered, and this is what happened the days following. 2 days before the expiration was to occur, I was looking at $50.73 on my underlying cost basis. And yeah, the covered call gave me $2.50, but I had lost over $10 per share. So November 19th, IBIT had plunged from 60 to 50. I froze. What am I supposed to do now? What do I do? How do I get this back? I'm down $10 and I've only got $2.50. I had full exposure to the downside, and this is the risk that isn't communicated more about covered calls. You have capped upside, but your downside on that position is fully exposed. And yeah, you get a bit of a buffer, but like I just said, it's like a pillow under your jacket. It is not a bulletproof vest. In order to get that bulletproof vest, you need to buy a bulletproof vest, and that comes in the form of a put, and we're going to talk about that in a bit. So I was exposed 100% to the stock. And I want to just show one little, this one here. So the risk is right there. Look at this, right? This is a profit and loss chart. This is by using the service optionstrat.com. If you're not familiar with optionstrat.com, it is completely free. Just go to that website, optionstrat.com, and you can put in your position. You can try and optimize it, move the sliders around for your expiry dates and your strikes that you're working with, and it'll instantly show you all of your profit and loss that you have sitting in front of you for that position. You can also take in multiple different strategies, cash secured puts, covered calls, iron condors, put credit spreads, call debit spreads, the whole thing. So this is what we're looking at, and you can see what we have for our profit and loss grid. This is where we are today with $54. And as the price goes up, right, we're all familiar with this. $58 would be the strike that I'm selling. That's where it caps off and does go up over there. But from 54 on down, it doesn't look very good in terms of profit and loss. And what I want to emphasize here is, to a degree, this chart isn't telling the whole story. This chart is showing you a very narrow view of the profit and loss for a variety of different outcomes. But it doesn't show you all of the outcomes because it only shows you what's available for the strikes. So as you come in here and you try and zoom this out, like I can't go below these strikes any further. So as I go down to here, I can't even see that strike on here. And I've zoomed all the way out to look at the entire range of outcomes. But I can't go down below $40. So Bitcoin can sell off from 54 down to 44, as we just saw, a $10 correction within 7 days. So below this, it's not going to show you that. And so that's part of the problem that we're having, is that we don't get a full picture of the entire covered call. Yes, we know the profile of a covered call is this, but we're not seeing the whole range. We're only seeing the default is 4% of the range. So as soon as you start to slide it more, you get a better picture, but even all the way out, it's not the full picture. This could continue all the way down to, this is probably where your $0 is. And so we get this huge section of red triangle that we can't even show on the screen here. And then you get this little sliver of, so that was my fallacy. When I went into this trade, I'm like, the profit and loss looks pretty favorable. It's not that bad. But then when you start to look at the reality and the whole spectrum of the outcomes, now you get to see why maybe it's not such a good trade. And it didn't hurt, right? Like when you get a losing trade, it kind of sucks. It sucks. And you want to get that money back. And sometimes the best thing you can do is just learn your lesson, dust yourself off, put in some rules in place, and safeguard this from happening again. And that's the position that I took. I put in some safeguards and I made sure that this error wouldn't occur any longer. And this is coming from a seasoned trader. I'm very familiar with options. I'm very familiar with trading these, but even still, sometimes I still make a fat finger trade, or I'll make a mistake like this and be overconfident is what it's usually down to. So we've covered this. The second hidden risk is high volatility traps. Sometimes we get allured to and attracted to high premiums. Remember, we talked about this in our previous webinar where we talked about covered calls, and we were looking for that extrinsic value, that value that's like that fatness over top of the strike, right? If I today is trading at $54 and we sell that 56 or 58 strike, why are we getting that premium on top of that? It's entirely extrinsic value. There's no value truly in that. It's all extrinsic value. There's really no intrinsic value. It's not truly worth anything, but there is an opportunity. And the value that is being priced into that is based on two things primarily. It's volatility and it's time. So the more volatile the stock, the higher the premium, the more duration there is in that option, the more you're going to be able to sell it for. And if you're on the buying side, the more you're going to have to pay for it for time and for volatility if it's rising. So one of the things that we find very attractive is high premiums. Well, that's because it's going to have a highly volatile underlying asset and also the time. But because we like to sell time about 10 or 20 days out, when we start to see high premiums, it's usually because of a volatile underlying asset. So just be careful, and we're going to go through some of the things that we can do in order to hedge ourselves. Hidden risk number 3, I got blindsided by external catalysts. There wasn't any single macro news event that occurred that hurt Bitcoin directly, but it was more of the wider, broader market at that time. They were repricing interest rate expectations. There was sentiment that maybe they weren't going to get a rate cut through December and maybe into 2026, that the number of rate cuts that we would be getting would be lower, and that we should be pricing in that into high risk assets such as Bitcoin. Also too, with Bitcoin, you also have to remember there's a lot of leverage, especially when it gets into those higher numbers, and it goes there very quickly. It had just come off going to 126,000 in October. And so when it was pulling back, there was a driver of deleveraging. So a lot of that had to be put into the Bitcoin price as well too. And nothing makes Bitcoin move faster than leverage, both up and down. So now let's go through my rules that I'm going to put into place to help myself avoid this. High volatility names. Okay, let's be honest, we're going to trade them. Okay, so if I'm going to come in here and say, hey, we're not going to trade high volatility anymore, volatility is good for us as options traders and as traders and investors. We want volatility. Volatility means opportunity, that there's an opportunity in the future that the price is actually going to be accurate and we're going to get solid returns. I like volatility. So we're going to trade it. One way to do it is with collars. A collar is like what you just see on this screen right here. This is enough of a zoom in on option strat to know what our profit and loss are and all of the possible outcomes with this trade. We see that we're going to be trading the 56 call option. That's our top cap side on the upside. And then we're going to take some of the premium sale of the 56 strike call option, and we're going to buy the 48 put. Yes, this means we're going to have to take some of that income and put it into that put, but that allows us to cap our downside risk on going up January. But what this does is it allows us to cap our downside up until January 30th. And with it being January 16th today, that means that we have 14 days of protection on this position, which in my example that I shared with you, that was enough time for this to correct and go down. And if I had a position like this, it would have saved me. So a caller is selling a covered call, taking some of that premium that we get from the call and buying a protective put. The put is always sold a little further out of the money than the rate at which the covered call was sold at. And that's because we need to have enough total overall credit or premium. You can do a zero premium, but that would allow you to really hedge in the position and nothing really is going to happen. One actually little bit I want to leave on this is professionals use this strategy. This is done by professionals. If you remember Bernie Madoff, this was the strategy that he was advertising to his investors that he was doing. So it doesn't have exactly the best name attached to it. He called it the split strike trade, but this is what it was. This was using hedging of calls and puts at different strikes, and that allowed him to have really good returns with very little deviation or downside performance. But of course, when we're trading these, you don't get always positive outcomes, and we're not trading like Bernie was advertising. But of course, we're not running a Ponzi scheme. Okay, never trade over calendar bombs. So this is really important, and I'll get into some tools that I'm using for knowing what the calendar is. So around earnings, if you can, you want to avoid earnings. Earnings are a binary event. It's either going to go up or down, because we're trading high volatility names such as Palantir, NVIDIA, Tesla, and MicroStrategy. We want to be able to just avoid those earning plays because they can be disastrous for your portfolio. If you are going to go into an earnings trade, maybe just check out having a lot of protection to the downside and making sure you got some puts with that. So take some of that income from the covered call and put that into the put. So you can do it just for a very short duration. So you could like come into an earnings play 2 or 3 days away, buy the put, just have it for a couple of days, buy it on Tuesday or Wednesday, and it expires for that Friday. That's enough to get you through the binary event of an earnings report. Dividends, they do put downward pressure on a stock, but usually we're just talking dollars and cents. If there's a Fed announcement coming up, interest rate decisions, just be aware of those. And then any crypto or regulatory news that could be coming out, because those could always hurt your position. The calendar tools that I use. So first off, Yahoo Finance or CNBC, pick your poison. Although we don't have a ton of respect for those news outlets, Yahoo Finance and CNBC, they do at least let you know when earning report are coming up. You can also use TradingView. If you go onto the TradingView website, they will also have the earning report in there. I can show you that real quick. So here, I'll just pull up, let's pick a stock that has an earnings report. Let's go with Amazon. So if you look at the Amazon chart here, and we're going to come into an earnings play, this is going to be for January 29th. So you just need to make sure your trade, if say you're doing a covered call, say you're doing put credit spread, you probably want to have it expiring before Thursday, January 29th. So just, that's an easy way to find out what your earnings risk is. Another one too, you can do in our joins we have this members only website with Join CFU. Go to the membership, log in, you're authenticated through your Discord account. You go to our PCS scanner. What this tool does is this scans the market all day long during trading hours. When the market is closed, it stops scanning. So you come in here to CrowdStrike. This is a really good trade scanner. What we're trying to do is get live reports. Take this with a grain of salt. This is off hours, so some of the data is just not the best. It's because we're only using last trade information or previous close information. It's just not the best when it's off hours. So if you are going to take a look at this, just make sure the market's open and that it has run at least one scan. But anyways, when you come in here, we pull in the earning report for you. So we know CrowdStrike, they're going to be doing March 3rd. We have the earnings report that are going to be coming up. We don't know what their revenue is. However, Q4, we have what they had last time. So pretty cool, right? All right, so let's go see. We have Amazon on here. I can just come up here and click the button, bring me down to Amazon. Your earnings report's February 5th. So we have a disagreement with you, buddy. Check it out, though. So the earnings date that is in TradingView here for Amazon is Thursday, January 29th, 2026. And in our Trading Ideas dashboard, what we have here in our trading here, I'll put it full screen for you so it's a little easier. Okay, so but Amazon here on our trading analyzer here, where we're scanning the market like 24/7 minus market hours, so minus market off hours. It says February 5th, and I was like, oh no, we got a data problem with our backend databases and scanners and API engines. Okay, check this out. So on TradingView, best site in the world for trading and charts. It says Thursday, 29th, January 2026. That looks authoritative and correct. And on our trading dashboard, what we say here is Feb 5. I was thinking we have a problem with our backend database. Go to Yahoo Finance. I'm like, I got to triple check this. Go to Amazon. What is up, Amazon? Feb 5? No. You mean our backend database is better than TradingView? That's pretty sweet. Amazon.com off the NASDAQ because I was like, maybe Yahoo Finance is drinking some Kool-Aid there. Check it out. Feb 5 on Amazon. Sorry, TradingView. The CFU backend database is better than you. All right. But it's important to know your calendar dates. And I guess sometimes you got to be able to double, triple check them. So we avoid our earnings date. And another tool, you can use Earnings Whisper. This guy is like like everyone uses this guy off of Twitter or X now. So go to Earnings Whisper, search him at the top of your menu bar, and you'll be able to follow this guy. He's an amazing. I mean, that guy should pay me. I promote that guy so much. Another thing you can do is tradingeconomics.com, a fantastic website for economic news because there can be so much economic news coming out. It's hard to keep it straight. You go to tradingeconomics.com and then you go into their calendar and then you say, I want to know next week or 2 weeks out, whatever your time frame, the impact that you want. So just put it 3 stars as 1, 2, and 3. These are going to be your heavy hitter impacts. And then the country, come on, it's US. So just put it on the USA and then you're good. Do you really care about Canada? I care about Canada. Okay, but US, set as US, and you got all the right upcoming events here. And you can also bonus on that. You see the previous and the consensus and the forecast there. So that's really great. So tradingeconomics.com. Let's move on. Act early, don't hope. Okay, so we always hear hope is not a strategy. It's just not. Okay, so if it's going against you, roll. In the trading community, people are for or against rolling an option. Myself, I'm a rollaholic. I will roll as long as it takes me to get that trade to be profitable. I like to continue to roll until I can turn this trade into a profitable campaign or profitable exercise. I don't trade stocks I don't believe are going to be around, right? So right now I'm against CrowdStrike. I think CrowdStrike's got some headwinds in front of it, but long term it's probably going to be just fine. Okay, so let's continue to roll and then we can turn that into a profitable trade. I don't mind also flipping and going bullish once it's time to go bullish on CrowdStrike. Another strategy is use the odd lot strategy. That is very easy to do and it works for you. So if the stock has pulled back, that's a time and an opportunity for you to actually buy some more shares. You already established a position in the stock, add a few more shares. Pulls back, add 2 or 3 shares, add 4 or 5 shares, add 5, 7, 10 shares, right? They're $50 a pop, very easy to add a lot. What that does is like Bitcoin or the company that you're trading that you believe in long term, over time, they're going to go up. Those odd lot shares are going to be below your cost basis now. They're going to improve your cost basis as well. And then when they rise up and the covered call goes in the money, you're going to get that call exercised against you. Sell some of those odd lot shares that you bought when it was down low and sell those to help you cover the debit that you need in order to close off that call if you want to continue to hold the shares. Okay, so just use that odd lot to your advantage. It's there for you. So it's an awesome time to buy. One good thing about covered calls, and this will always be true for covered calls, is they do encourage a buy low, sell high mentality. When the stock goes into the money on the covered call, that's likely a good time to be selling, especially if you're selling that covered call when you're into resistance. Let me show you that. Okay, we're here in Broadcom, right? So if you're going to sell a covered call on Broadcom, I would really like to sell that 410. This would be a great covered call to sell. This is a great strike to sell on Broadcom. So if Broadcom got up to like 365, 370, that's a great time to sell it. Sell that 410. It's going to have really good returns on that. And once it gets into this is going to be high resistance. That's the time when you'd want to sell the shares anyways. But let's say you sell that 410 and it starts creeping down here below your cost basis through here, and it starts to go towards that 200-day moving average. Maybe that's a time to be adding an odd lot to go with your established 100 plus shares that you have. Full disclosure, my buddy owns 500 shares of Broadcom, but he loves he can't stop talking about Broadcom. But that's an opportunity, even if it pulls back, put in 20 more shares, put in 30 more shares, build that odd lot so it can go with your shares and it can be there. Here's another way to make sense of it. Don't sell calls on all your shares. Just do it on 80% or half of them. Okay, that's even done very often by ETFs that are doing high yield covered call income streams. They only sell it on half the shares because they want to have some participation to the outside. Okay, so this is my lesson from the $700 loss that I had. I turned it around. Covered calls work brilliantly, but they do best with a plan and a system in place. They are natural and they are very easy to understand. That's one of the benefits of covered calls is everyone can understand them. The 3 rules are gold. Keep these, put them onto a card, or just have this slide deck printed out and close to you. If you're going to be trading high volatility names, put a collar on those. Be aware of your calendar, the upcoming events, macro and within the news scope of that stock. So have a way to handle the undesirable outcome. We talked about before too in our previous episode, where with covered calls, 4 outcomes, right? It rockets to the moon, it rises but doesn't go above your strike, it goes sideways, and it goes down. In 3 of those, you profit on the first 3. If it rockets, you still make money. If it goes up and doesn't hit your strike, you still make money. If it goes sideways, you still make money on that premium. The only way you lose is with number 4, the very last one, when it goes downward. We're going to manage that 4th outcome by rolling, right? We go up and out, right? We go above our cost basis and we go further out. If you can't do that, that's going to be the natural question that you're going to ask. And what if I can't do that with my cost basis? I would buy an odd lot of, assuming you're not willing to take the loss, buy an odd lot of shares. Okay, you got to just put a little bit more in and have that there sitting on the side with your 100 shares or 200 shares, put in some more, and then be patient. Okay, wait for it to come back because we're in a good position, right? We're in a good stock. You didn't pick trash. Don't pick trash. A lot of you guys out there are picking trash. Stop picking trash, okay? Don't pick trash. You pick quality stocks or quality stocks that we think have really good opportunities in front of them. If you can't think of a good stock to be doing this with, I'm going to pound the desk and beat my head. Tesla. Tesla is a fantastic company to go with. Look at TSLL. It is the 2 times leveraged Tesla. It trades for in the low 20s. Bring that baby across. This is another alternative to Tesla. I'm not recommending that you go and do double leverage trades, okay? But this trading at $18, so it's very easy to get into, very manageable, and you can get very similar performance to the Tesla outright. You got this is the same chart as Tesla. Start small and don't rush. Okay, there's no need to rush covered calls. Start small and don't rush. If you're with Cashflow University, the best trading community that is around and online, start small. So one of the services that we have within our full membership, our elite option trading service, is we have Kyle. He's our best trader that we have. He does phenomenal results. Get into Cashflow University, start following his trades. Number 2, he also has a channel for 10K accounts. If you have $10,000 or less, he also posts trades into there that are designed for small accounts. Those are great ones to get in on. And a lot of his trades that he does put in a 10K account, you can also put in and do multiple contracts and get better results. The good thing about covered calls, simple, easy, and also you can get, this is not word of a lie. You can do the Google research. You can put this through Grok or ChatGPT if you want to. What kind of consistent monthly returns can you expect by doing a covered call strategy? It is 1 to 3% monthly, depending on your underlying, and 12 to 24% annually. Those are great returns, and you're going to love them with covered calls. Those are great returns. What was your worst covered call trade that you entered into? I would like to hear about it. And if it's a good one, we can bring you on and we can talk about it here live. Share your stories in the Discord, share it here on YouTube. If you like our channel, subscribe. It always helps us out. And coming next, we're going to talk about the wheel strategy in our next episode. And we're going to show how we can use the wheel strategy in combination with the covered call strategy to create a steady income flywheel. Ooh, a flywheel. Yeah, you definitely want to have a flywheel. Trust me, you want a flywheel. WTF moment of the day. Iran. The hell. So you're telling me if I want to buy a Bitcoin using your Iranian rial, I need 1.4 billion. What is this? Speaking of buying trashy stocks, Iran, a trashy currency. Look at that in one day. In January of 2026. I don't know what day that was on the chart. Your currency went through the shitter. Your currency got absolutely destroyed. So Iran, do better. And if you're Iranian, I hope Bitcoin, because if you have one Bitcoin in Iranian terms, you are worth $1 billion real. But in reality, it's only 100,000 US. All right. Thanks for being, wow, this is such a fantastic picture. I don't know if he's trying to be like me or if he's trying to be like the bull or what's going on here. But thanks for being with us. Cashflow University, or CFU as I affectionately call it. We are a full service option trading community. We have a Discord, we have a website, we have a blog, we have a newsletter, various ways and different ways in which you can reach out and participate in our community. Our most active is the Discord. We have over 1,000 traders who learn from us and who also teach us. I learn new things every single week and every single month that I'm in the trading community. And I love hearing the success story. So many different people, small accounts and big accounts. And it's great to hear what people are doing and just what they're accomplishing with their wealth goals. I think it's one of the best things that came out of COVID, if anything did come out of COVID, is that it brought us together online. And when we came together online, it gave us an opportunity to share our shared experience, and we're able to pull together as a community. And this is actually going to this graphic with the bull. The graphic that is in there is called the rise of the retail trader. And that has really come to pass in the last little while. I love it how, as a community, we can work together, we can trade together, we can see opportunities together, and we can pounce on them. Like when everyone made all that crazy money on Palantir, when everyone made that crazy money on GameStop, when everyone made that crazy money on AMC, it's awesome seeing us take it to Wall Street and actually do really good. Last year in 2025, the retail trader did so good. We beat so many hedge funds and we showed them that retail are not dumb. And when we come together and trade together, we get fantastic returns. We knew last year was an opportunity to buy the dip, and we will continue to be fantastic traders together. One way that you can join an online community is to join CFU. Go to joincfu.com. Take a look, check it out. Grab our free ebook that we have. It'll outline a lot of the systems that we use here at CFU in finding the next opportunity to trade.